In this set of videos, we're going to talk about stock valuation. And as has been the practice in some previous videos, we'll discuss the security and a little bit about issuing stocks. And then we'll move into some theories about pricing, etc. And then we'll end with some techniques to apply to value or define the worth of a common stock. So what's the difference between debt and equity? Well, I mean, there's really four basic things that really separate these two concepts, if you will. But before we go on, we need to understand that both creditors and shareholders, they are both investors in the company. So that is the one thing that is common between the two. So even though they are both investors, there are some substantial differences in their rights and their expectations. So stockholders, shareholders, have a voice in government. They get to vote on some major issues of the corporation. Creditors have no voice. They have no vote. The claims, with respect to claims on income and assets, the shareholders own the company. So they own, in quotes, the assets. In addition, since they own the company, they have claim to profits of the company. So the net income of the company essentially belongs to the shareholders. Now, how that is distributed is a matter for another series of videos. But the shareholders of a company are entitled to all of the assets of the company and all of the profits of the company. With respect to maturity, we assume that stock has an infinite lifespan, that it essentially will last to infinity. And of course, debt, being a contractual obligation, has a fixed timeline, a time horizon when it matures. And in the end, there certainly is a tax treatment that is different between the two. Interest expense is tax deductible to the corporation, but dividends are not. So when a company is considering payment, one has a benefit of a deduction, and the other one does not. So again, there is a difference, and we will discuss these in this chapter a little bit. We'll also discuss it when we get to some later videos when we discuss things like financing and dividend policy. So just to kind of highlight a little bit on this interest idea, right? Interest payments to debt holders are tax deductible expenses by the company, but dividends are not tax deductible. So what a tax deduction does is it effectively lowers the cost of that expense. Again, since we get to write off taxes, we are saving tax dollars when we're allowed to deduct things from income. And interest is certainly no exception to that rule, that there is a benefit to being able to write off interest expense. So common stockholders are sometimes referred to as residual owners. They are the true owners of the company. But as residual owners, they only receive something if there is something left off. So after we've paid all of our obligations for the years, whatever money is left over belongs to the shareholders of the company. So the only thing that shareholders are assured of, the only thing they know for certain, is they cannot lose any more than what they have invested in the company. So the maximum loss is the stock price when they purchased the asset or the security. And because of this uncertainty, that is why shareholders are compensated usually higher than the creditors. They have a riskier position, so they take or they require higher compensation for taking those risks. Now, the common stock of companies can be classified many ways. It could be privately held or publicly held. It could be closely owned by an individual or a group of investors, or in the case of publicly, it could be owned by thousands of investors, literally, maybe even tens of thousands of investors. Now, the shares of privately owned firms, which are usually small corporations, are just not traded. They are shares just like public companies, except they are not traded. So since they are not traded, we don't have a market price for those shares. So we may have to analyze these kinds of companies a little bit deeper if we are considering purchasing into a private corporation. And again, since large corporations are publicly owned, their shares are actively traded, and we can get lots of information about those companies. So there is a term that's referred to as par value. And without spending a great deal amount of time talking about par value, essentially what we need to know is this is an accounting tool. When there are transactions within the corporation that have to do with common stock, retained earnings, etc., those transactions are booked or journalized or recorded utilizing the par value of the stock. Usually it's a very low number, but there is a number, and that is what's used by the company to do the actual accounting for common stock transactions. So let's talk about shares in general. When a company becomes a corporation, they have to file what's referred to as a corporate charter. It's a guideline, right? It's the rules that they're going to follow. One of the things that it stipulates is the shares. So the authorized shares are the total number of shares that are permitted to be issued by this charter. So that's, unless they change the charter, this is the maximum number of shares they'll ever be able to issue. Now, some of those shares are issued. They're becoming a corporation, so they're going to issue shares to some investors. Some of those shares may be held by the company. They may not be shared. These are what are referred to as unissued shares. And of course, later on, as the company deems necessary, they can then issue those shares at a later date. Of the shares that are issued, there are two classifications. The number of shares that's actually currently owned by an investor are referred to as outstanding shares. This is what is owned by the investing public. Treasury stock is stock that was issued by the corporation to an investor but has been repurchased by the corporation. And in later videos, we'll talk about why they might want to do that. But for purposes of this chapter, what we need to understand is these outstanding shares are the only shares that vote, and they're the only shares that receive dividends. So as we're thinking about managers making decisions that affect stock price, it's these shares here that we're ultimately narrowing in our focus on. When a company wants to issue stock, if it's a publicly traded company already, there are some stipulations on how they do that. There's something referred to as the preemptive right. Essentially, this says that the current shareholders have the right to maintain their proportionate ownership in the company. So if you own 10% of the company and the company issues new shares, you have the right to buy 10%. Now, when a company issues stock, what happens, right? They refer to this as the dilution of ownership. This is what happens when some of the shareholders cannot buy these additional shares of stock. So now the voting rights, the rights to assets and profits, are now distributed over a wider range of people. So we have a dilution of ownership when they cannot repurchase these shares or buy these shares. And in the end, we also have a dilution of earnings. Now, if everybody buys the shares, if there were 10 of us and each one of us bought our 10%, the dilution of ownership wouldn't happen because we still all own 10% of the voting shares. The dilution of earnings wouldn't happen because we're all going to receive our 10% of assets and profits. The only time we worry about dilution is when the shares are issued and ultimately purchased by a new investor, someone from outside the current list of shareholders. So how the company does this is through a financial instrument called a stock rights. Essentially, they're an important tool. They allow us to purchase shares, usually at a little bit of a lower price than the current stock price, but we have the right to buy these shares, and this right has value. So if you don't want to exercise this right, if you don't want to buy these new shares, you can sell these rights to someone else, and then they can buy those shares. So this is just a way for the company to issue stock, sometimes very quickly and at a very low cost to the investing public, because they don't have to go through the entire process of underwriting and using investment bankers, etc. The voting rights that we have entitle us to vote primarily on the election of the board of directors, but there are some special interests or issues like mergers, etc., that we may have opportunities to vote on. And again, votes are generally assignable. That is, you can give your right to vote to somebody else. This is what's referred to as a proxy, because a lot of small shareholders don't attend the annual meetings. They can sign a statement transferring their votes to another person. So existing management generally receives these proxies, right, because it's able to solicit them at the company's expense. But the idea here is someone, it could be the corporation, it could be a major shareholder, can send letters to say, hey, look, I want this to happen. The company's not doing the right thing. We want to make a change. Will you please proxy your vote to me so that I can vote to make this change for us? So finally, if we think a little bit about, again, characteristics, you know that companies pay dividends. Most of them are paid in cash. There are, however, sometimes stock and merchandise dividends. But here's the important point to understand is the common stockholders are not promised a dividend. They expect certain payments based on the history of the company, but they are not promised this. So before common stockholders receive their dividend, remember we talked about residual owners, all other obligations are going to have to be paid. So we're going to talk briefly about preferred shareholders in this video, but we want to understand that for you to get a dividend, if you're going to get a dividend, all the obligations have to be paid, and obviously there has to be cash in the checking account to make those payments. So one of the statements I think that's frequently misstated is that the payments of the dividends is at the discretion of the board of directors. So it's not incorrect, but it's not technically correct to say that management decides what the dividends are. It's not the CEO or the CFO. It is the board of directors decides how much and when the dividend should ultimately be paid. We have talked briefly about international investment. So obviously there is an international stock market, and you can buy shares of international companies on an American exchange, right? So, and there are lots of companies that trade on the New York Stock Exchange. They trade on NASDAQ, right? Now, if they trade on United States exchanges, they have to follow our rules, which can be expensive and can be inconvenient, to say the least. So what happens if they don't trade on an American exchange? Well, you can buy them from the foreign exchange. The challenge is now, number one is you have to worry about currency issues, but now you also have to understand that the regulations of the stock market that we deal with, these exchanges don't follow those rules. So there are some risks that we take as investors when we buy from a foreign exchange. We could buy multinational companies. However, that's not true diversification if that's what you're looking for. But quite frankly, the easiest way is to buy mutual funds. Most equity mutual funds have an international component. In fact, frequently it can be 5 to 10% of almost all stock equity funds have an international piece. Now, true international mutual funds don't invest in anything in the United States. However, there are mutual funds referred to as global mutual funds that do invest in the United States. And since the United States stock market is the biggest, they are usually heavily weighted to U.S. stocks. So a global mutual fund might have 90% U.S. stocks. So if you're looking for diversification, you might not be able to get that with a global mutual fund. There are things referred to as ADRs and ADSs. These are American Depository Receipts. And essentially, a bank has invested in some foreign companies. They've gone to the foreign exchange and bought the shares there. And now they maintain the stock, and you buy a piece of paper that references that stock as your ownership. Now, there is a kind of stock that's referred to as preferred stock. If you buy this stock, you get certain privileges that look an awful lot like common stock. However, you have a position that's senior to common stock. Remember, common stockholders are residual owners. Preferred stockholders have a fixed periodic dividend. So in that sense, they act an awful lot like bonds with respect to fixed income and expectations of income. The par value of preferred stock is usually a specified dividend percentage. Sometimes it will be stated as a dollar amount, but regardless to that, it is always the same. Now, there are some no par preferred stocks. They don't have a face value, but these are the ones that almost always have to have a stated annual dollar dividend. The financial analysis of preferred stock in the real world is actually likened to debt. So those financial analysts who are looking at companies, and those companies have preferred stock, they treat preferred stock like it's debt. And that is because that's the way most corporations treat it themselves. So it just gives us a better picture, if you will, of the obligations that the corporation expects that it owes. It's often, again, kind of considered quasi-debt because, again, it sort of looks like debt, sort of looks like stock. It doesn't have a maturity date, right? It has a fixed claim on the firm's income, right? It takes precedence over common stockholders. So since it has a claim higher than stockholders, it is considered to be slightly less risky than common stock. But because it acts like stock, it is actually considered to be a little bit more risky than debt. So again, it's in between. It has characteristics of both kinds of securities. Most of the time, preferred shareholders don't vote. So although sometimes they're allowed, the preferred shareholders can have a member on the board of directors. So somebody can be there that acts in their best interest. But in general, they do not vote for anybody on the board of directors or on any issues inside the corporation. And finally, just like bonds, there are some restrictive provisions, right? There has to be information there about how dividends are paid. How do they sell securities? What happens in the case of mergers or repurchases of common stock, right? One of the features is something called the cumulative preferred stock. Now, as a rule, since common shareholders have a residual right, the dividends to preferred stock have to be paid before any common stock dividends are paid. And if it's cumulative preferred, the rule here basically says that all dividends have to be paid to preferred shareholders before common shareholders, including any shares that have been missed. Now, if you have non-cumulative preferred, basically you're just entitled to whatever that preferred stock dividend is in that period. You cannot recover dividends that have been missed. Preferred stock, from time to time, they'll have a callable feature that allows them to, the corporation to retire. The period of time is not as important as the price that they can call it back as. And then, just like bonds, we also have a conversion feature that preferred stock can be converted into common stock. And again, there's a set of rules that determines what that transaction ultimately would look like. So this is the end of the first video that quite frankly talks primarily about the characteristics of stocks.